Japan's central bank did something yesterday it hasn't done in 30 years. It raised interest rates to 1%. That's a milestone that would normally send a currency surging. Typically, higher rates attract foreign capital, which means more demand for the currency, which means the currency strengthens. That's economic spike deed.
Except the yen didn't strengthen. The yen is sitting above Beklutius per dollar, roughly where it was before the hike, and in the days leading up to the decision, professional traders didn't reduce their bets against the yen, they increased them. Short positions on the yen jumped to their highest level in 9 years, with speculators holding over Shi-1 Wutsane bearish contracts, the largest pile of bets against Japan's currency since November Nissan Shusitident.
Here's the question worth sitting with. How do you raise rates to a 30-year high and end up more under attack from currency traders?
This is the Japan factor. The Bank of Japan voted on June 16th to raise its benchmark policy rate from 0.10% to 0.10%.
On paper, this is a historic moment. The last time Japan's central bank held its rate at 1%, Bill Clinton was in his second term, Amazon had just launched as an online bookstore, and Japan's bubble economy had already been deflating for 5 years. The BOJ hasn't seen a rate this high since Senkyugekyuju Wuten.
There's a detail that makes the optics of this meeting unusual. The central bank's governor, Kazuo Ueda, wasn't there. Ueda, 63, was hospitalized on June 10th with an infected liver cyst. He submitted a written policy outlook but didn't vote. Deputy Governor Ryozo Himino presided over the discussion. Deputy Governor Shinichi Uchida delivered the post-meeting press conference.
Japan's most significant monetary policy moment in 3 decades happened without its chief central banker in the room, but the decision itself was never really in doubt. A Reuters poll conducted before the meeting found that 104% of economists expected a 25 basis point hike. Every market indicator pointed the same direction. Core consumer prices in Japan are running at 0.8% above target, and Middle East tensions have pushed energy costs higher. The yen's weakness has made imports more expensive, feeding inflation further.
So the BOJ hiked, and almost nobody was surprised. That's the problem. There's an old rule in financial markets: buy the rumor, sell the news. When an event is priced in completely, actually happening changes nothing.
The BOJ's June hike was as well telegraphed as a rate decision can be. When 94% of economists agree on something 3 weeks before the announcement isn't news, it's confirmation. The moment the decision came through, currency traders checked their models, found that nothing surprised them, and went back to doing what they were already doing, betting against the yen.
The logic of the carry trade is brutally simple. Japan's policy rate is now 1%. The US Federal Reserve's rate sits at 13.74%. That's a differential of roughly 0.4 percentage points. If you borrow money in yen and invest it in US dollar assets, treasury bills, corporate bonds, almost anything, you earn 0.4 points per year on the spread before exchange rates move at all. That's not a marginal opportunity. At scale, it's a machine for generating returns.
And scale is the right word. Analysts at Invest.com put the outstanding yen carry trade at roughly $1 trillion when you include FX swaps, currency swaps, and off-balance sheet positions. Even conservative estimates of on-balance sheet yen borrowing run to tens of trillions of yen. These positions don't unwind because the BOJ raised rates by a quarter point. They unwind when the incentive disappears, and right now the incentive is still enormous.
The Japan Times reported on June 15th that leveraged funds held back Shergold 1,000-plus contracts betting against the yen in the week ending June 9th, the highest bearish positioning since November Nisang Dane. That data was compiled before the rate hike. After the decision came through, USD JPY held comfortably above back Shergold 6 Dane.
The carry trade didn't blink. Here's the part that makes this genuinely interesting rather than just frustrating. Japan cannot take the medicine that would actually fix the yen problem.
to structurally unwind the carry trade, to make borrowing in yen unattractive enough that hedge funds and pension funds stop doing it en masse, Japan's central bank would need rates somewhere in the range of 2 to 3%. That's where the math stops working for carry traders, because the spread narrows to the point where exchange rate volatility can eat your profit.
But Japan's total national debt runs to somewhere around 160% of GDP, one of the highest ratios among developed economies. The government already paid Sanchi E10 trillion, roughly $4 billion in debt servicing costs in fiscal year Nisen Ruv, a G10% increase over the prior year and the sixth consecutive record high. For the first time, debt servicing alone crossed the Sanchi N trillion threshold.
Every Arshawul basis points of additional rate increases adds tens of trillions of yen to eventual interest payments as bonds roll over and are refinanced at higher rates. Getting to 2% would dramatically expand that burden. Getting to 3% would turn Japan's fiscal projections catastrophic. The Finance Ministry's own analysis projects Japan's fiscal balance deteriorating to -6% of GDP by fiscal Nisen Senjurwol even at current rate assumptions.
Japan's government bond market is already sending warning signals. The 10-year Japanese government bond yield has crossed 2%, a level not seen in decades, and analysts expect it to continue rising toward 3% as the BOJ continues reducing its bond purchases by hikrin billion per quarter through March Nisen Nishiptained.
This is the bind. The BOJ needs higher rates to control inflation and restore credibility. But higher rates cost Japan's treasury enormous amounts of money, and the rates required to actually fix the yen would be fiscally ruinous.
So the BOJ raises rates slowly, carefully at a pace its bond market can tolerate. And the carry trade reads this, correctly, as a green light to keep running.
There's a phrase worth borrowing from Washington policy discussions revealed preference. What you say you want matters less than what your actions reveal about your constraints.
Japan's revealed preference, through 3 years of careful rate normalization,
The BOJ will raise rates when inflation and fiscal credibility demand it. It will slow walk those increases to avoid blowing up the government's interest bill. It will taper its bond purchases gradually to avoid a bond market crash. And it will watch the yen with genuine concern, launching currency interventions when the Ministry of Finance gets nervous. But it will not sacrifice its bond market management to save the currency.
Currency traders have internalized this. The yen carry trade is essentially a bet that Japan is structurally constrained, that the BOJ can't raise rates fast enough to make borrowing in yen unattractive, and that the Ministry of Finance's interventions will continue to provide temporary relief without changing the underlying dynamic.
Since November Miten Shati, that bet has been, by and large, correct. What would actually change the picture? 2 scenarios. First, a sustained Federal Reserve rate-cutting cycle that narrows the US-Japan differential from the American side. The Fed has come down from its peak of 0.10% to 3.5–3.7%. If that continues, the carry trade math weakens even without Japan doing anything. Second, an inflation shock serious enough to force the BOJ into genuinely aggressive tightening, but that would likely require something much worse than the current Ni-10% CPI reading.
The next BOJ hike is expected in the fourth quarter of Nisen Nizrulok, potentially pushing the rate to 10%. Analysts and traders will spend the next 3 months watching the same variables. Is the Fed cutting? Is CPI rising? Is the Ministry of Finance losing patience?
Until those dynamics shift, the carry trade has its answer. Japan's central bank just raised rates to the highest level in 31 years. Traders yawned and doubled down.
That's not irrational. That's a very careful read of the situation.
Sources: Bank of Japan Policy Statement, June, Salute. Nisei ni Salute. Japan Times. Yen short bets jump to 9-year high as carry trade revives, June, Salute. Nisei ni Salute. CNBC. Bank of Japan hikes rates to each %, highest since Senkyu Fat Q's war, June, Salute. Nisei ni Salute. Bloomberg. Yen short bets reach 9-year high as carry trade activity surges, June, Salute. Nisei ni Salute.